go right now. So it's great to have you all here. Really appreciate Jen, the support of you guys and the organization and our good friend Michael Schumann, et cetera. So I'm extremely fortunate to be involved in the National Coalition for Community Capital. Our organization came together about a decade ago, largely fueled by the passage of the Jobs Act and the idea that investment crowdfunding was going to become a thing. And a thing that we could use, those of us that were in and around and working in community and wanted to make a positive difference. And so we started off really as an educational 501c3 formed in 2016 and 2017. We quickly realized the need for advocacy and so started doing policy work. And in 2022, still kind of wishing that the movement would grow faster, we decided to actually get on the ground and work in communities. And so we have been doing that since. The focus of that work has evolved. It evolved very quickly. The very first conversations we had were with folks that were based in community. And like the second question they asked us is, could we put together a community investment fund? And a really quick primer on community investment funds before I dive into some slides that we have. Community investment funds were that we have in the U.S. were structured by a piece of legislation passed in 1940 called the Investment Company Act. And those fund structures are largely very unkind to non-accredited investors. That's 85 to 90% of the population in any given year, roughly. And very unkind to smaller communities. That is, that you needed a large community of at least 50,000 to stand up a fund and make it work financially. So that's untenable since most of our communities don't have 50,000 people in them. And most of them don't have only exclusively wealthy investors in them. And so how do we make that difference? So we were very fortunate to have in our organization Brian Becken, who is an attorney, a securities attorney, despite the fact we really like that, despite the fact he's a securities attorney, because he's one of the good guys. And Brian's firm, at that point known as Cutting Edge Capital or Cutting Edge Counsel, now known as Pathlight Law, have really been innovators in this space from the beginning. And so what Brian ended up doing together with some members of our team was to develop a fund structure that actually works in communities that are quite small and works in communities to allow everyone to invest and works to allow communities to create wealth, both individual and community wealth, as well as local governance in a fund that reinvests everything back into the community. So that's how we kind of got to the community investment space. We are now piloting projects all over the country. We launched our first one last fall. We're going to launch 2 or 3 during this year and next year, who knows? But we are looking to grow it really dramatically and are finding a lot of alignment with a lot of organizations. So, all right, I'm going to share my slides with you now. And does that look good? Can we see that? No? Okay. Let's try again. How about now? All right, thumbs up. That means it's usually good. All right, so cultivating strong local economies. So this is NC3's mission to educate, advocate, and activate community capital. And again, that really speaks to the work that we've done. So we have a lot of good educational resources on the website, which is, by the way, in the process of evolution to a better, brighter, cooler, better looking, easier to use website. So stay tuned for that. We have been advocating, so really working on the policy side. As well, including providing a proposal to the Securities and Exchange Commission about 4 years ago to create what we called then a 21st century community investment fund, which we wanted to do all the things we wanted it to do, which I've articulated. And then Activate is us on the ground working with communities to help them activate the idea of community capital and community investment. So community investment funds are pooled investment vehicles. So talk to any investment advisor, and what are they going to tell you? That don't put all your eggs in one basket. And so that's a pooled investment vehicle. And the reason that we want to put pooled investment vehicles in our communities, and in fact, in every community in the country, is that we believe firmly that we need to sort of recenter the way capital flows back into our communities. So historically, that's the way it worked. When our communities were all started, wherever they are in the country, there was a local bank. There were probably a couple local banks. Everybody put all their money in that bank, either in the savings account or checking account. And then local lenders made decisions about where mortgages were going to go, what businesses were going to get funded, et cetera, et cetera. And as you all know, those local banks that used to be in all of our communities are now almost a thing of the past. Bank consolidation has happened largely because of legislation that's passed that has really made it untenable to be a small community bank and exist and survive in this landscape where they are. So that bank consolidation has meant that that local entity that reinvests 100% of it back into its community just really doesn't exist. We do see some creative things happening. We see some credit unions really stepping up and taking a good spot there, but a lot of them don't. And any of those entities that operate under government rules have certain challenges in order to operate, and those are problematic in many cases in terms of how capital is deployed and how it's invested. But pooled investment vehicles we think are really important. We love investment crowdfunding. It's a great thing. And we love what's happened to it. We love that we're getting close to $3 billion worth of investments in investment crowdfunding happening. But we want this kind of investing to be ubiquitous. And for it to be ubiquitous, it needs to be easy to do, it needs to be de-risked, and pooled investment vehicles are the way to get there, we believe. So we have piloted two different community investment fund structures. And if Brian Becken, my colleague at NC3, who's the securities attorney, was here, he'd say, well, there's lots of them. And then when he started talking, you would realize that there's actually only a handful of the multiple permutations that are in that Investment Company Act of 1940 that are really usable. And there's less than that, less than a handful that actually can build wealth both for the investor and for the person or the organization or the business that has capital deployed from those funds out from it. So we put together this DCIF and ACIF that's on the chart in front of you. This is our own legal strategy. So these are, if you go to the SEC and you plug in DCIF, nothing's going to pop up except maybe NC3, maybe that'll pop up. But so these are fund structures that we've sorted out and that we are currently pilots. So right now, our four initial pilots are all DCIFs. We have a pilot right now that's a charitable loan fund, which we like, but charitable loan funds don't provide the opportunity for wealth building for fund investors. So they do for the entities that capital is deployed to, but fund investors can. So let me quickly go through the DCIF. The secret sauce of this, because these are workarounds, where they're compromises, because the kind of fund that we actually want does not exist in U.S. laws or Securities and Exchange regulations. We are working on that, and we actually hope out of the, and this is the only political comment I'll make today, the chaos that's happening in D.C., we think that we have a fairly good opportunity to create this kind of fund that we really want to have. So we're working both within the SEC and legislatively to see if we can get that done. It may be because these could be construed as deregulation that they will get heard at this point in time. And based on statements that leaders of the SEC have been making, we think that we may have an opportunity effectively to resubmit what we submitted several years ago and get that done. But in the meantime, the DCIF's workaround, its magic is that it is a real estate fund. So 60% of this fund must be invested in real estate, which, as it turns out, is actually really useful right now. You may have heard recently that there's a housing shortage all over the country. And so the communities we're working with are not having any trouble trying to find real estate investments to make for that 60% of the fund. The beauty of this fund, there's a variety of beauties to it, but the beauty of it is that once 60% has been invested in real estate, the other 40% can be invested in anything at all. So you could invest in those Main Street businesses. You could invest in a big business that was in the community or a project, anything that could effectively uh, address debt. If you can manage debt from whatever the project is, this fund could invest in it. It has a lot of really lovely parts of the structure. It can sit in a nonprofit. It can sit in a for-profit. It can stand alone. It can be part of a local unit of government. It offers an actual wealth building opportunity to any investor. You can invest again as long as you're in that 60-40 parameter, basically in anything that you want to, sort of any kind of real estate or any kind of other securities investment like in a business is legal to do. The DCIF is also open to any means that's legal and used in the US to raise capital. So that's a private or public offering. So investment crowdfunding, we're seeing a lot of investment crowdfunding raises into DCIFs, et cetera. So a lot of flexibility there. And we can do debt or equity investments out of it. So we can loan money to businesses, or we can own a piece of those businesses if it's the right structure for that particular business. And as noted before, it can generate income in a variety of ways. The Aligned Community Investment Fund is a fund which we do not have a pilot for yet. We are in conversations with several folks to it. This Aligned Fund, we really designed this for a colleague of ours. Her name is Donna Harris, and her business is called Builders and Backers. And it is an entrepreneurial support organization. So what Donna worked in DC during the Obama administration. She had her own firm on K Street. She's a successful venture investor. And she decided after taking a hard look at that world that really wasn't where her passion was. Her passion was on starting businesses. And so she designed a proprietary program that is very successful at taking entrepreneurs with an idea and actually building businesses. And then because she was an investor in the venture capital world, she had access to a lot of venture capital and fast growth capital. So she set up within her company a bucket of venture capital and another bucket of venture capital, of fast growth capital. And when people went through her training program and were venture eligible or fast growth potential companies, she could invest capital in those. When we were introduced to her, she was looking for a way to get regular investors in that so that the 80% of entrepreneurs that came through her program that were not eligible for venture capital and were not fast growth companies, but were Main Street businesses, community-based businesses that would enjoy modest growth, but not the kind of growth that's going to attract venture or angel investors into it or fast growth investors into it, 10x kinds of returns. And so we really designed this for Donna and others like her who did service and then had an opportunity to invest in
Do you
those
like
that she
that?
provided services to.
Okay.
So so there's a couple of fundamental differences. The ACIF is actually raised into the entity, so it isn't separate from whatever the entity is. The entity can be a nonprofit or a for-profit, although the fund is a for-profit fund. So you have to be careful about that. The one really fundamental difference from our perspective is that regulation crowdfunding cannot be used to raise capital into the ACIF fund. And because of that, it makes it more challenging to get regular folks investing in the project. There are, again, workarounds of that, and a common workaround would be doing a direct public offering, which, like a Regulation A offering, allows an unlimited number of accredited or not accredited investors to invest. And another option is a Regulation A offering. So regulation crowdfunding has a $5 million ceiling per raise. A Regulation A offering has a $75 million. So if it's a significant business, if you're going to be doing work in the tens of millions of dollars, then then an ACIF and a Regulation A offering is a way to bring as many regular folks, regular investors, non-accredited investors into the mix as possible. And there are no restrictions, unlike the DCIF, which requires a specific percentage, that 60% be in real estate. There is no similar requirement for an ACIF. Next. One of the things that we did in order to accelerate this movement, it seemed like a good idea to create an accelerator. And so we did that in 2022 when we moved to on the ground and we started working with communities. And so our accelerator, does essentially these 5 steps. So we do discovery calls at the front end. We are typically responding to queries and requests to have conversations with us because they want to know what this is about. They heard about it. They saw a presentation, they read something, and they're interested. So we talk to that first individual, that first organization that comes to us, and we do a couple of discovery calls to see what it is that the community is after. One of the questions we get all the time is, well, what's community? And it's a really good question. And as it turns out, it's a whole bunch of different things. And what we do is let the people who come to us define community for themselves. So they know they represent some community in some way, whether it's a sector or whether it's a geographical community or whatever it is. But that's the community that we would look to serve when we respond to them and when we ultimately build a fund. So we understand what it is that they want to do, the things that they want to bring to their community. We require alignment with our 4 values, which are listed on our website. I typically characterize this as if you have a heart and if you have a head, you're probably aligned with our values. If you're missing one of those, maybe not so much. But in any event, so those are the things we look for. So we have some discovery conversations, and then we very early in the game, we want to engage the community. So we want the community to feel a really sense of ownership about this. We're going to do something really unusual. We're going to do something that most people in the community have never done before. We're going to make a direct investment in a local fund or a local project. And we're not only asking them to do something that they never did and probably their parents or grandparents never did, we're also asking them to do something with their money. And because we're asking for that, we know that that's a challenge for folks. We want to make sure that we engage the community early. It's not specified on the slide, but we typically look for a trusted entity, and that may be the organization or people that come to us, and it may be somebody else. It could be a single individual. It could be faith-based organizations. It could be a local unit of government. It could be a great business that's been in the community for decades and decades. It could be an NGO that's in the community, a variety of things. But finding that trusted entity is a really important part of getting the community engaged and trusting the message. Then we help you identify. So we counsel, if we're building a community investment fund, that you already have a project in mind. And the reason for that is, again, this sort of historic disconnect between us as members of a community and as investors in the community. So we want to make it easy for people to get excited about this idea that there's going to be a fund in the community. And it is our perspective that investing in a project that's easy to recognize and identifiable and high value in the community. Take an old building in downtown that's been abandoned for 30 years, and there's been a bunch of efforts to try and revive it, and it's never come about. So if we go in there, we want the community really excited about that. If it's a brand new building, we want to have conceptual drawings that people can be excited about and recognize this is going to be great for the community. So we identify that project. Then we talk about the fund structuring. What kind of fund do we need? How much money needs to be raised? How are we going to raise capital into it? And then typically walk through that first fundraising episode with you. During this time, we're going to bring to the table or work with your local attorney. We're going to bring to the table or work with local technical assistants. We're going to bring to the table or work with local educators who really understand this space. And I will say that typically on the attorney side, on the legal side, and on the community training around investment side, there are very few people in the country that really understand this space and communicate it. We know who they are, and we will bring them to the table if you don't have them. One of the things that we do very often is co-counsel. So we'll bring in an attorney because number one, there are very few securities attorneys in the country to begin with. And number two, of those that are there are hardly any that have paid any attention to investment crowdfunding and through this growth of community investment funds. And so they don't know that space. But we do often work with attorneys who are aligned, again, with our values and whoever it is that comes to have that conversation with us. And we will co-counsel with them so that our goal is to enable communities to do this on their own. And so we work to that end as much as possible, but we're not going to sacrifice the quality of what's done because there doesn't happen to be a local attorney who's a securities attorney and understands this space. Next. We're talking about cultivating strong local economies, and we think core to that is a vibrant local entrepreneurial ecosystem. And the reason that we believe that is because historically we've seen that when we look back at communities and we see vibrant communities, there is invariably a lot of locally based businesses. And of course, those businesses have been challenged a lot of late. If we look back over the past 30 years, we've seen in addition to a dramatic decline in the number of local banks, we've seen a similar dramatic decline in the number of local businesses. So there's a lot of consolidation. There's a lot of big box stores that come in and drive out. And now we have these little box stores, the Dollar Generals that come in, and they gobble up some of that space that local businesses could be. So the problem with all of those businesses is that the business model in every case is extractive. They want to come in and put the least amount of money in the community and take the most amount of money out of the community because that's how to run a good business, where the business and the investors in the business make money. It's not a balanced scale. It is a scale which takes a lot out and puts a little in. And you can understand why that would happen, but you can also understand as you extrapolate this out, the more you do that, the more danger it is for local communities. So we want to see lots of local businesses, a vibrant local ecosystem, businesses that can take that dollar that moves into their community instead of exiting out of the community, recirculate in the community, because that's where wealth building takes place. I always like to quote the statistics around Black Wall Street. When Black Wall Street was operating in Oklahoma 100 years ago, their capital recirculated among the many small businesses in that community. We've seen estimates from like 80 times to 130 times. So it was crazy. They made a dollar worth $100 by circulating it around within the local community and local businesses. Today, economic developers get super excited if they get 5 turns of a dollar before it exits. And if we're getting 10 turns of a dollar before it exits the community, we're really doing super well. So we want to get to the place where that happens. We're doing a big project right now in Detroit. And the community we're in right now, a dollar comes into that community and exits about 20 minutes later. And in all of Detroit, a dollar that comes into Detroit exits within that day. So it's really stunning and really sad. And it's because there's no local businesses there. So we think the heartbeat of our communities needs to be local businesses. And that local business doesn't have to only do business locally, but it needs to be based in our community. So we have no problem with businesses that are selling globally, but that where they're headquartered, where their physical location is, where they make their products or develop their services or whatever, that to us is a local community business. And we want to be able to support that and have that business support us as well. So we want to keep local money and we want to recirculate it. And that way we can bring wealth building to all of our communities. I'm not going to spend much time here other than to note that this slide is about resilience, and resilience is super important, and it's a really big problem right now for our communities. And so and this is a very technical definition of resilience that talks about anticipating natural hazard, but we would posit that resilience covers a variety of things. We've watched over the last decade villages in England just completely disappearing. And they completely disappeared, not because people didn't want to live there, not because it wasn't a beautiful place to be, because there were no local businesses left anymore. And we've seen those places in America as well. Crossroads in some communities in rural areas where there used to be a really vibrant community and there were 2 or 3 little stores there, and those are gone. And it really means the decline of the community. So to address all the various kinds of resilience, we really think that local ecosystem is the way to go. So how do we get engaged in this? So if you're an entrepreneur or a business owner, so one of the things that we certainly encourage is to take a look at investment crowdfunding. We think that every local business, really irrespective of if there is a local community investment fund, because our goal again is a local community investment fund in every local business should still be raising capital on its own and will be raising capital on its own. And we encourage them to look at community members in order to build those businesses. We've seen some really fantastic statistics come out of this movement, the local investment movement and investment crowdfunding. Two notable things, I think, or the most two notable things are, one is what happens when folks in a community invest in a local business. Well, number one is that local business, the owners of that local business are going to look a lot more like the members of the community than other businesses that may come into their communities. So this is a really fantastic and horrible horrible piece of data, horrible and also awesome. That is in 2024, investment crowdfunding sent about 44% of its investment to women and minority-owned businesses. I still haven't seen the final report from what VC did in 2024, but in the first 6 months of 2024, venture capital spent less than 2% of its money on women and minority investors. And historically, if you look back, they've been 2 and 3% for most every time. So, I mean, that's horrible, right? It's hard to imagine. That almost seems deliberate, right? That how could we get so little of that money moving into, not moving into half of the population of the country. So it's much more equitable. It's much more democratic when we're seeing that local investment. So we say, if you are a small business or you're an entrepreneur or a business owner, for sure, take a look at investment crowdfunding as a way to raise capital. We have a bunch of really good platforms out there that offer all kinds of services and help for people that are in that space. And we would encourage you to take a hard look at those to see. If you have a community investment fund in your community or you think they may be interested in one, we'd encourage you to kind of talk to people about that. What we see moving forward is a community investment fund in the community. That fund would potentially do seed investing in those business startups or expansions, or maybe they would do match money in those communities, but they would not usurp that ability or the need for the individual business to raise capital, but would add to that capital. We talk about, instead of access to capital, we talk about building capital to access for those communities. So flipping that paradigm and thinking about, let's build capital that these community businesses that we care about so deeply and that make our places so unique can raise capital their own way. And if you're a community member, absolutely look for a crowdfunding platform to see if there's investing that you can do. There's all kinds of great projects. You can go on a website and look at the offerings that are out there. You can read the bios, you can read the financial projections, et cetera. And in about 15 minutes, you can register for one and actually start making investments. And if you're really interested, we would love to have you join our accelerator group and help us work to build you a community investment fund. All right, so that's that. Now I'm happy to stop sharing and respond to any questions or corrections. It's entirely possible that I made 8 or 10 significant mistakes in that last presentation, so I'm happy to stand corrected. So
Thank you so much, Chris. There was a lot to cover in a little bit of time, and folks had a lot of questions, and we'll definitely open it up to the whole group. But I know that hopefully I'm pronouncing your first name correctly, Mish Raymond. You had probably 3 questions during the presentation. You want to go off mute and ask your questions? That would be awesome.
Sure, sure. Hi, Chris.
hi, Mesh.
So fundamentally, this revolves around the idea of developing a community investment fund in the Eastern UP. So this is small population, for those of you not part of Michigan, the Upper Peninsula of Michigan. So I think the population of that whole region is like 35,000. So you mentioned something about basic criteria that generally look like they're good indicators for the success of a community or the development of a community investment fund. One of them, I thought I heard you say 50,000 people.
Yes.
Can
So
you say more about the criteria?
for sure. So the 50,000 was a reference to what we have historically seen from fund structures that were built in the Investment Company Act. And so the fund structures, especially the DCIF that we've created, is really designed to scale down. So all the funds will scale up. That's not ever a problem. In fact, most of the conversation, well, can they scale up? Can they scale up? Just like businesses, you would think that every single business was a venture business or a fast growth business, the way the conversation goes in this space. But of course, that's not the reality. Venture is about 2% of businesses get venture capital, and 8 or 10% get fast growth capital. So the vast majority of our businesses that are in our own communities are never going to be eligible for
Right.
venture and never going to be eligible for that. So anyway, so the funds we're building, the DCIF, we're actually looking at a couple of communities under 2,000 people right now
Oh, wow.
to
Okay.
build a community investment fund. And we're doing that by eliminating a lot of the costs that would be related. So we're trying to simplify what's a very complex legal and structural process, and make it easier for folks to do. So we think that we're going to be readily able to scale down to pretty small. We'll see whether we can work in these very small communities. But one of the other things that we're talking with the National Association of Counties about having counties hold these funds. As I noted, the DCIF can sit in a local unit of government. And we see counties as a really good solution. The challenge, of course, in counties in Michigan, because I'm also in Michigan, but I think historically and almost across the country, they're pretty sort of backward-faced organizations created in the 1800s. And so they're not really innovative as a whole. However, there are some that are doing really creative work. And part of the challenge in working in local units of government in particular is they always want to know who else has done it. And so once we have a few responses to who else has done it, then I'm optimistic that we'll see more uptake by some counties. But so, and obviously in a region like the UP, you have other strong entities that exist that are already in the community, already have trust, and those might be places to talk about putting a fund up. But I don't think 35,000 is at all a problem with setting a fund up. I think that's plenty. We're really confident 10,000 people is going to be entirely possible. So the question is 5,000 or 2,000 or 3,000? So, and we think it will be.
InvestMint, is that one of those lower population communities?
Yeah, so investment, that's a project in Petoskey, Michigan. So if you're not from Michigan, it's right here, beautiful northwest coast of Michigan. That's one of the advantages we have here in Michigan. So, it's a small community of about 4,000. However, it's a heavy tourism area, so it like triples in size in the summer. But they have their major problem in that part of the country is there are so many tourists that have historically come up and bought property. A lot of wealth from Chicago, for example, has come up and bought property on Northwest Michigan. So it's very difficult to get property to build affordable housing on. And so the group in Petoskey, again, a community of about 4,000 people, is putting a fund together to buy and maintain affordable workforce housing so that someone can wait on the tourists when they come to town.
So you mentioned something about the investment and what they're using it for. Is there an ideal amount to start a community investment fund, like to raise? Like, I know when you're doing venture capital, you want 100 million or 50 million or whatever it is. What is an ideal place to start?
Yeah, so I think again we're just piloting these right now, so I don't want to make it sound like we've done hundreds of funds because we haven't. We're working and right now about between 25 and 30 different funds, and we've launched one. We have 3 that are going to launch this year. But what we found already is that it really depends upon the community and what is it the community wants to do. We encourage that identification of a project at the front end. So I would say in response to that, what project do you want to do first? Raise money in order to accomplish that project, and then worry about going forward from there.
I love that.
DW's got a finger up, so I want to hear what you have to say.
Yeah, DW Farrell here with Localite, and then Chandra's here with Local Fund. Good to see you, Chris. I have a question for you, but I wanted to just recognize that I see a lot of new faces, and I really just want to encourage you guys to look into membership with Amoeba, invite others who are peers. When Chris and Jen and others are hosting these events, we're not competitors, we're collaborators, and it's just exciting to see these faces. I've been a member since I guess 13 years, and I mean it's just wonderful to see a couple collaborators go off and build something amazing. Connections happen. So Chris has built up his coalition that complements yours potentially. So that's the shout out. Chris, one thing about these different types of fundraising vehicles, whether it's regulation CF or permutations of Reg D, typically have a marketing cost or the legal upfront costs, and then there's a CIF model as well. So can you kind of speak to, and I'm trying to set this up in a way that makes sense. Can you kind of speak to if you're doing one-off fundraising versus the pooled approach and what those costs really are?
Yeah, for sure. Thanks for the good question, DW. We're now quoting numbers in the kind of $10,000 to $20,000 range to set up a basic fund in a community, and which would give you an opportunity to raise up to $5 million. We're now Catherine, who's our director of operations, who's on the call, is just sent out a couple of proposals last week at just under $9,000 for NC3's time, and also for some technical expertise. And in addition to that cost, you will also have legal costs. The legal costs are typically going to be the largest part of that demand. And you will also have platform costs if you're going to use one of the platforms to raise capital on. And there are a number of good platforms that are doing good work and host raises, and you can use a platform to raise capital into either an individual project or into a fund. If you're just doing a one-off and you want to do an investment crowdfunding campaign, I think right now we're in the 5 to 7% roughly range, maybe 5 to 9% range of costs. So it's a success fee. So if you're going to raise $100,000, you're going to put $5,000 to $7,000 in it. You're also going to spend some money on a monthly basis to be on the platform, $200 or $300 a month, maybe, to do that. There's some variability in the space. So you really have to look and see what looks like for you. So it's definitely less expensive to do a one-off. On the other hand, if you build a fund structure and you do the work around that, and you get there for $15,000 to $20,000, you can raise $5 million into that every year with a fairly modest cost to do so.
Cody, I see your hand up. I just wanted to acknowledge that Jen and Elias had asked a couple of questions, and then I'll hand it over to you, Cody, just around the corner. Good to see you. But Jen had, I think some of this has been answered, but Jen, did you want to elaborate? You were asking about special considerations for state outside of Michigan. You want to go off mute?
Hi. Yes. Hi, Chris.
Hey, Jen.
How are you?
I'm lovely. Better having heard you. Jen and I worked together 10 years ago, right, in Michigan, and she's now out west somewhere.
Yeah. It hasn't been 10 years.
Hasn't it? It seems like 10 years.
No,
Usually I get it wrong. So.
I'm excited. My gosh, you've come a long way. This is tremendous. But the economic developers up here in sort of rural area, Colorado, are unfamiliar with the fact that we can do investment crowdfunding, equity crowdfunding, and we have a law that was passed by Hickenlooper in 2015, but I'm curious to know if there's any considerations that I should be looking at with Colorado. If you know of any laws that would, I mean, I can look into it myself, but I thought
Sure.
maybe you might.
No. Yeah, no, happy to do that. And your folks are not alone. This is really a very tiny movement right now. Even the investment crowdfunding world is getting to $3 billion is still a tiny drop in a giant bucket. So we are very much a small movement and growing. Have big aspirations, and we think we will make them happen. But it's going to take a lot of time to change perspectives that have been cemented in place for 70 years, right? So, a lot of states, in fact, 34 states have investment crowdfunding laws, and Michigan, as it happens, was one of the very early states. We were the second contemporary and fourth in the history of these laws. So there was a couple of states that did laws in the 1980s, and nothing really happened there. But the laws that are out there that are state-based are largely not used today because there is federal legislation, the Jobs Act, which was passed in 2012, investment crowdfunding, regulation CF, so the most common kind of way to raise capital, that didn't come into operation until 2016. But right now, any state can use regulation crowdfunding to raise capital, and it gives you the advantage of raising capital from any state in the country. So my wife and her partners did an investment crowdfunding campaign 5 years ago. And although Michigan has a really good, better than a federal exemption opportunity, they did a national raise because they had family and friends that were out of state who wanted to invest. And so they got 45 investors from 7 different states, even though the largest number of those were in Michigan, right near where we are. Jen, that would not be a problem. One of the things that we would look at if we worked with your team is to say, is there an advantage to using the Colorado law? Can you raise more capital? Is it easier to raise capital under that law or not? I don't know that offhand, but we would take a look at that to see whether that was the case or not. And then if there were advantage, we would take a look at that. So we're actually doing a big project in Detroit right now. We're actually going to do 2 raises. We're going to do one using Michigan's law because it allows for a much larger investment from non-accredited investors. So wealthy non-accredited investors in Michigan can put $10,000 into a raise and no limit on the number of raises they do during the year. So you could actually put a lot of money in. On a federal level, most non-accredited investors have a ceiling of about $2,500. The wealthiest non-accredited investors, I think it's under $4,000 or right around $4,000 that they can invest once a year. So we would take a look at that to see what makes sense. The platforms that are out there all typically have the capability of doing national raises. Some also do some state-based raises. So it really would depend on how active that's been in your state, or if there were a couple platforms that made it possible to do a state-based raise. And again, we can help you find that out if you wanted to go forward. Does that answer your question, Jen?
Yes, it does. Very good. I'm looking forward to getting the recording of this and sharing it. I've got about 8 people that are very curious here.
Fantastic.
That's awesome. And those of you who came in a little later, we are going to be sharing the recording, but I'm going to pass the mic over to Elias, and then Cody, your hand must be getting really tired with it raised, but
His virtual hand, right? Yeah.
Go ahead, Elias.
Thanks. Chris, this is terrific. I'm taking furious notes here. I just had a curiosity about the kinds of businesses that seem most attractive to the CIFs that you've been putting together so far. Is there anything notable about that? Are they all over the block, or what are people looking for, would you say?
All over the block, and I would thanks for the question, Elias. One of the things I would say is, we really don't have enough data yet on community investment funds to draw any definitive conclusions, but we have enough data looking at investment crowdfunding to say, what are people interested in investing in? And it is literally across the spectrum. So there has, at the outset, we expected to see a lot of real estate being invested in, and virtually no real estate happened for the first 3 or 4 years of investment crowdfunding. Now we're seeing a lot more real estate, in fact, some specific platforms designed to do real estate being invested in. Obviously, we love real estate from an investment perspective because there's a hard asset behind it, safer than an investment in a business. But what got funded a ton at the very beginning, and this may not be very surprising, microbreweries, right? There were lots of investment. The very first raise that happened in Michigan was a microbrewery, and there's a lot of states where that was what happened. Entrepreneurs are out of the box in the first place, right? And so they were quick adopters of this. And for some reason, people like to drink beer and are interested in investing in microbrewers. But across the spectrum, we've seen real strength like in green energy and renewable stuff, coffee shops, but arts and science, tech, I mean, everything has been invested in. One of the really interesting things that's happened, I've been concerned for some time watching this space about what I've called the venture capitalization of investment crowdfunding, because it has gotten, it's shiny and new, make a lot of money fast. That is always going to resonate with some folks. And so they bump that way. But what's happened actually the last several years now, investment crowdfunding has been used by venture and 10X folks to kind of test market it out. So they've gotten a chance, those regular investors have gotten a chance to get in very early in some of these deals because they're using it as a test market before they go and approach big money to do that. So wide open, and effectively, what does the community care about? What's important to it? That's where you're going to see the most traction. Great question.
Cool. And over to Cody, and
Finally,
then Thomas,
Cody,
and
I've been
then
worried about him.
Kimberly.
So
Thank you, Jen. And first of all, thank you for putting this together. And thank you to Jen for the invitation. And just looking over your website, I am kind of kicking myself a little bit now for recently trying to reinvent the wheel for community investment fund structuring as our organization had last year. My name's Cody Morrison. I'm a executive director of Monadnock Economic Development Corporation in Southwest New Hampshire. Question for you, Chris, is in the how have you seen, like, what models are used to address issues of liquidity when there are overlapping investor term maturities and actual physical asset investment maturity? So for instance, if you were doing a loan program and you are making a loan to a real estate project that may have a 15 or 20-year maturity and an investor that only has a 10-year investment, how do funds typically ensure liquidity outside of very strict, narrow underwriting on the project side? And I'll add the caveat that, imagine you're in a state that doesn't have a sales or an income tax and doesn't capitalize these programs. I can see Jen shaking her head as she knows New Hampshire's fund landscape.
yeah. Well, liquidity is one of the big challenges in the space, candidly. So, there are definitely some things that we can do structurally at the front end. It is actually fairly straightforward if we want we want shares to be sold between investors or in the community, that kind of thing. So you can definitely do that kind of thing to address liquidity. There is also a secondary market that is evolving, which we think will be sort of the end of the day on that. And there are a couple of platforms that are in that space. They've created what's called a special purpose vehicle in order to do that. And I would point you at Honeycomb Prairie, that's out of Minnesota, I think, Wisconsin maybe, and doing really good work in that space.
That's Silicon Prairie.
Silicon Prairie, yeah. What did I say? Honeycomb? Yeah, Silicon Prairie. I think that organization is the smartest in this space and looking forward, and they have from day one said that liquidity was really high value for them. We also see Woody Neese, whose organization got the Jobs Act passed in 2012, and he now heads up Crowdfund Capital Advisors. they've also created an entity which can address liquidity as well. So from a long-term perspective, we expect to see those kinds of structural changes or evolve that allow the liquidity issue to be addressed. In the meantime, there are some, again, internal things that we can do sort of on a case-by-case basis to make sure there's liquidity possible. The other piece that we've looked at, so for us, wealth building is really important, and addressing historic inequity is really important. There are lots of communities that are doing just fine, thank you, from a wealth perspective, and there are lots of communities that are not. And so one of the things that we do is we advocate, we sort of flip the paradigm return and say, let's make the least stable of those investors in those underserved communities get the best return on investment. And we've also used philanthropy to backstop those. Corporate guilt money is also useful in that place as well. So that way you can ensure building of wealth for those least able investors, make sure they're getting the best return. So for their $50, they're going to get $75 back no matter what happens. That turns out to be a pretty small piece of the overall pie on a lot of projects. In any case, that local least able investor number gets to be pretty small. So it's easier to address liquidity in that way in some different ways. So, and then for others, I think the mitigating factor here is most people who are investing in community and in community investment funds are not that a return on investment is not the be all and end all, because they're getting something done that's important to their lives. And that actually is going to have a bunch of benefits, some of which will turn out to be financial. But that actual return on investment is typically secondary. So one of the things that we talk about in this capital stack when you're putting money together is that community capital is probably going to be the most flexible capital that you have. And for that reason, it's a really terrific way to move it forward. But really good question, and I think you do have to be paying attention. And obviously, you have to look at your own market and your own community to see how important is that liquidity can be. But we can plan for it. Again, more or less on an individual basis right now until that secondary market gets really up and running.
Cool.
Thank you.
So we have about 5 minutes left, and I know we have lots more questions than 5 minutes we'll take care of. But I just want to continue to have people ask questions, but also know that we have other opportunities to get to know NC3 and ask more questions. So don't feel like if you didn't get your question answered that you're out of luck. So just keep that in mind. Going to Thomas and then Kimberly.
Thank you, Chris, for that great presentation and the excellent work that you're doing. I realized a long time ago that we have to reduce our dependence on dollars. And what we really need to do is to provide local homegrown liquidity by monetizing the credit of local SMEs. And so I've written 4 books on the subject over the last 40 years. And the last one is called The End of Money and the Future of Civilization. And I'm in the process of rewriting it and published 14 chapters already on my website, beyondmoney.net. And the current chapter that I'm working on is specifically about local community financing and empowerment. So, we've got buy local, we've got invest local, we've got sell local, but all of that can be facilitated to a much greater extent if we create our own means of payment within the community. So what I'm talking about is local currencies issued by trusted issuers and mutual credit clearing exchanges, where we basically offset debits against credits amongst the businesses that are already in the community and stimulate import substitution by investing through crowdfunding in businesses that can create locally what we currently import from outside the community. So I'm just throwing that out there because I would like to collaborate with you in rounding out this community empowerment process.
Well, I appreciate that perspective, Thomas. And obviously, we've seen some of this happen. There have been local currencies created in a few locations and that kind of thing. And I think to the extent it's possible to do it, it's definitely a good thing because we're really at the same end, right? We're getting to the place where we want to empower local communities and have them make the decisions about what happens there. And we're taking an aligned path, but a different one with the work that NC3 is doing at this point. So
I see that, and it's totally complementary. That's the point.
Definitely is. Definitely is, for sure. It's like cooperatives. People talk, we don't focus on cooperatives, but we love cooperatives. Cooperative ownership, whether that's employee or community ownership, it's fantastic. The more we can do that, the better it is for all of us. So
Thanks again.
And one last question from Kimberly, and then we'll wrap up.
Thank you so much, Jen, for hosting this, and thank you, Chris, for great content. My name is Kimberly Bonner. I'm the Small Business Development Manager at the Center for Community Wealth Building in Denver, Colorado. My question is really focused on the Accelerator program and getting more detailed information about that. Is there a cost associated with being even able to apply and get accepted to the program? I know you mentioned costs associated once you are trying to develop your fund. But I really want to get into the weeds about the program itself, and also, is there a certain duration of the program? Do you kick people out after a certain amount of time? That kind of thing.
yeah, so we'll start at the end. We don't kick anybody out, right? You can choose voluntarily to leave us, but we're not going to leave you. So again, because every community, every circumstance is unique. What we would love you to do is send us an email, give us a call, say we'd love a discovery meeting, and then sit down and spend an hour, 2 hours with you. And if you've got a team there to talk about specifically what it is you're looking at, but we're gonna build what makes sense for you. Those broad 5 categories that I described earlier are the things that we're going to do with you. I would definitely encourage you to go to our website. There's a workbook there. There's an ebook there. There's some stuff that you can work through on your own. That will facilitate moving through that process, but it'll give you some of the ideas of things that we're going to be talking about and doing. The other thing that we don't have it yet, but we're working on it, and that is a community investment fund in a box where we're going to you're going to pay for this thing, and it's going to be a set of documents and check boxes and things that you can do sort of ahead of time that will reduce the costs to set up a community investment fund. You're still going to want some experts to look at it, including some attorneys and that sort of thing at the end of the day. But that's one of our goals, because we're concerned that if a few more of these things start taking off, we're going to get dozens of people calling us every week, and we're not going to be able to spend the time that we are right now. And so we're thinking about, if we have to scale up dramatically, what do we have to do in order to do that? So we are thinking about it. But in the meantime, we're really happy to have conversations with you and set up a call or two to kind of look at what that looks like. But spend some time on the website. And by the way, one of the things Catherine is doing is working on leading a team that's going to make our website way cooler and way better than it is right now. But the content is still pretty good. It's a little bit wonky in some places, so we do know that. So.
Well, thank you, Chris, for joining us, and thank you all today. Thank you all for joining us today. Again, I'm going to send you the recording. I'm going to try my darndest to wrangle the slides from Chris. Please check out our upcoming events, and thank you all for everything that you all do. And see you next month.
Thank you very much.